Welcome to the Deep Dive, your shortcut to being well-informed. Today we're jumping into Complete Aviation Solutions Deep Dive number 126. Our mission, like always, is to unpack some really fascinating sources, pull out the key insights, and maybe give you a few aha moments about what's happening in aviation. We've got some great stuff today. Global traffic, airline financials, some pretty cool sustainability news, and even a look at a market you might not expect.
That's right. We'll be digging into the latest numbers, the latest developments, trying to figure out not just what's happening, but why it matters for air travel and cargo overall. Get ready for some surprising details and some really important context.
Okay, let's kick things off with that global pulse.
Yeah.
First up, we have these preliminary figures from June 2025, specifically for the Asia-Pacific region. What's the big picture for passengers and cargo there? What are we seeing?
Well, the headline is basically continued growth, pretty much across the board, but maybe with a few wrinkles. For international passengers, yeah, sustained growth. That was helped by demand picking up ahead of the mid-year holidays. Specifically, airlines in the region carried, 31.2 million international passengers in June. That's up 7.1% compared to last June.
Okay, 7.1% growth sounds pretty strong. So demand's up. What about capacity? Did the airlines match that?
That's the interesting bit. Demand, measured in RPK's revenue passenger kilometers, that grew by 8.0%. But available seat capacity, that actually went up a little faster, 8.5%. So what happened was a small dip, just zero point 0.4 percentage points, in the average international passenger load factor. It landed at 81.7%.
Ah, okay. So more seats available than the growth in passengers, pulling load factor down slightly.
Yeah, exactly. And what's key here, is this shows a moderation in those really high growth rates we saw earlier.
Yeah.
It's more in line with the longer-term trends we've seen since, say, 2024. It kind of signals things are settling into a more mature recovery phase. Airlines are tweaking efficiency, not just chasing that rapid post-pandemic rebound anymore.
Right, makes sense. Now let's talk cargo. Is that story similar? Continued expansion?
Absolutely. International air cargo demand that's measured in FTKs, freight ton kilometers, it grew by a pretty solid 5.6% year-on-year in June. A lot of that seems to be on the back of a rebound in global manufacturing, especially, consumer goods, intermediate goods. And we're still seeing things like front-loading shipments, maybe some rerouting because of trade uncertainties, which boosts air freight.
Okay, and the capacity story for cargo. Did supply keep up with that 5.6% demand growth?
It actually outpaced it again. Offered freight capacity increased by 7.1%. So similar to passengers, this pushed the load factor down. The international freight load factor dipped zero point 0.8 percentage points, ending up at an average of 62.1% for June. So yeah, growth is definitely there, but the supply side is expanding too, which, can put some pressure on pricing.
Zooming out a bit then, what about the first half of 2025 overall? What does that period tell us?
Looking at those first 6 months, Asia-Pacific Airlines carried 190.5 million international passengers. That's a big jump, 12% up year-on-year. And international air cargo demand also showed really resilient growth, up 6% compared to the first half of last year. It really does highlight the strength of the economies in the region.
So strong numbers for the first half. 12% passenger growth is significant.
With
But looking
some-
ahead, is it all smooth sailing?
Well, not entirely. The near-term outlook, it still looks pretty positive for travel, especially with ticket bookings up for the peak holiday season. But there are definitely some, let's say, clouds forming. Things like tariffs being introduced more widely that signals rising inflation. And we're seeing a bit of a dip in business confidence, suggesting, growing concerns about the global economy. These things could impact both travel and cargo further down the line. So carriers in Asia Pacific, they're definitely watching cost pressures and trying to adapt while still looking for growth.
Okay, that's a great regional overview. But, this is where it gets really interesting. How does all that filter down to a specific airline group? We've got some Q1 results here that maybe show a slightly different side of the story.
Yes, exactly. For the first quarter ending June 30th, 2025, we saw a major airline group report pretty steep drop in net profit, down $266 million, or nearly 59%, to $186 million. And this is despite their group revenue actually climbing $72 million, about 1.5%, to almost $4.8 billion. It really shows how revenue growth doesn't automatically mean profit growth, especially right now.
Wow, a 59% profit drop, even with more revenue and strong demand. What exactly drove that down so much?
Yeah, it was a combination of things. One factor was lower interest income. That was down $61 million because they had lower cash balances and, interest rates were cut. But crucially, the group also had to account for a share of losses from associated companies. That was a hit of $122 million, mainly from an integrated partner whose results became part of their books late last year, around December 2024.
Ah, okay. So financial factors beyond just ticket sales. What about their operating costs? You mentioned inflation earlier. Did that bite them?
It did. Group spending rose 3.2%, up to about $4.4 billion. And yeah, most of that was from higher non-fuel costs. Those are up 8.5%. That was driven by adding capacity, about 3.7% more overall. And like you said, those inflationary pressures hitting key costs. Interestingly, though, their net fuel cost was actually lower by nearly 8%, mainly because fuel prices dropped quite a bit, almost 17%.
Oh, that's surprising. Lower fuel costs.
Yeah, but that saving was partly eaten up because they used more fuel overall, adding $70 million to the cost. And they also had a fuel hedging loss this year compared to a gain last year, which added another $109 million to the expenditure side. So the result of all that, group operating profit for the quarter came in at $405 million. It's down about $65 million, or almost 14% from the year before.
Right. So even with cheaper fuel per gallon, other costs and those hedging results really squeeze the operating profit. Okay, so let's look at their core business passengers and cargo. How did they perform?
Well, the group's main airlines actually carried a record number of passengers, 10.3 million, up nearly 7% from last year. So demand was strong, like we saw regionally, and their passenger load factor nudged up slightly, quite 7 points to 87.6%. Traffic growth just edged out their capacity expansion. However, and this is a big one, passenger yields, basically the average fare per distance flown, they slipped 2.9%.
Ah, so they filled the planes but made less money per passenger.
It's exactly down to 10.0 cents per RPK. And that's primarily because of increased competition. More airlines adding flights, putting pressure on fares.
Okay, that makes sense. What about the cargo side for this specific group?
Cargo revenue actually fell slightly, down $10 million or 1.9%. Again, the issue was yields, which dropped 4.4%. And their cargo load factor also dipped a bit, 0.8 points to 56.9%, because their cargo load growth, while positive at 2.8%, didn't keep pace with the capacity they added, which is up 4.2%. So yeah, a tougher market for cargo revenue for them, even with that overall regional demand increase we talked about earlier.
So given these financials, the competitive pressure, what's their strategy with their fleet and where they fly? Are they pulling back, expanding?
They seem to be pushing forward, actually. They've got a pretty young fleet, 204 aircraft on average, just under 8 years old. And importantly, they have 72 more planes on order. That signals ongoing investment. Their budget carriers were active too, adding new Airbus A321neos, a Boeing 787, even an Embraer E190-E2. So they're diversifying the fleet. Network-wise, they cover a huge area, 129 passenger destinations, 133 for cargo. And what's really interesting is how they're actively managing it. Their budget arm launched new routes, like Iloilo City and Vienna. And with another associated budget airline closing soon, they're planning to ramp up capacity significantly into places like Malaysia, the Philippines, Sri Lanka, Thailand. They want to keep that Singapore hub strong. It shows they're being pretty agile, responding to market changes, consolidating where they can.
Okay, that's a deep dive into how one major player is navigating things. Fascinating stuff. Now let's pivot completely. From financials to the future of fuel. We've got something really exciting here, a development in sustainable aviation fuel, or SAF. This sounds like it could be a genuine milestone.
It absolutely is. I mean, this is the first time that something called solar fuel has actually been used in civil aviation operations.
Yeah.
We're talking about a clean tech company delivering synthetic crude oil made using solar energy directly to a major airline. This isn't just lab stuff. It's getting into the real-world system.
Solar fuel, how does that actually work? What's the process?
So the company essentially uses concentrated solar energy, water, and CO2 captured from the air or industrial sources.
Okay.
They have this Dawn production facility that makes the synthetic crude. This crude was then shipped to a refinery in Germany, processed into certified jet fuel, just like regular crude. And then, importantly, it was fed straight into the airline's normal fuel supply system at Hamburg Airport. Seamless integration, that's key.
Okay, seamless integration is huge. But the first delivery was, what, 190 liters? A barrel, that sounds tiny in aviation terms.
It is a small volume, yeah. Represents maybe 7% of the fuel needed for just one flight, say Hamburg to Zurich. But the significance isn't the quantity yet, it's the proof of concept. It shows the whole chain works. Production using solar energy, refining using existing infrastructure, and use in regular flight operations. It validates the technology and the process. It's a massive step from a pilot project to showing it can work industrially.
Right, proving the pathway. So what are the big potential benefits here, especially for hitting those tough emissions reduction targets the industry has?
Well, the potential is enormous. This solar fuel could cut CO2 emissions by up to 99% compared to fossil jet fuel. that's, almost completely carbon neutral if the energy used is fully renewable. And the company is also claiming that this process is potentially the most economical way to make sustainable synthetic fuels. They're aiming for a production cost below €1 per liter eventually.
Wow, below €1 a liter, that would be huge given fuel costs. So this airline and tech company, they've been working together for a while.
Yes, they've been strategic partners since 2020. Started with this vision basically of turning sunlight directly into liquid fuel. This delivery is really the first major tangible result of that partnership.
So what's next? How do they scale this up from one barrel to something meaningful for the industry?
That's the plan. They proved the concept at a test facility back in 2022, launched Dawn, the first sort of industrial scale plant, in 2024. Now, the focus is squarely on significantly scaling up production. The goal is to actually enter the commercial market starting from 2027. They're also working hard on getting the whole process certified under the EU's Renewable Energy Directive, which demands at least a 70% cut in greenhouse gas emissions compared to fossil fuels. So it's a clear roadmap.
Very cool. Okay, so we've gone from global trends to airline finances to future fuels. Let's shift focus again, this time to a specific market that seems to have some, well, untapped potential. Vietnam's business aviation sector.
Yeah, this is a really interesting one. It raises a pretty stark question. You've got Vietnam, right? Over 100 million people, booming economy. Yet, as of mid-2025, there were only maybe 10 or 12 registered business jets in the whole country, and only 3 of those were actually available for charter.
Only 3 jets for charter in a country that size. That sounds incredibly low.
It's a staggering ratio. It means access to private flights is extremely limited and consequently really expensive. It seems almost like a hidden, underserved market.
Especially when you contrast that with Vietnam's economic performance, right?
Exactly. That's where it gets fascinating. Vietnam's economy grew over 7% in the first half of 2025. That was its highest growth rate in 15 years. You've got a rapidly expanding group of ultra-high net worth individuals. And in just the first quarter of 2025, the country pulled in over $10 billion in foreign direct investment. That's up 35% year on year.
So you've got booming local businesses, tons of international investment coming in. These are exactly the kinds of users who need business tools like private aviation. So where's the disconnect? Why so few jets?
A big part of the gap seems to be the type of aircraft available. The market severely lacks mid-sized jets. What Vietnam mostly has are the really big heavy jets or ultra-long-range planes. These are super expensive to charter, especially for the shorter hops that are actually really popular. Think Ho Chi Minh City to Da Nang or out to Phu Quoc. Maybe an hour's flight.
Ah, so using a giant plane for a short trip makes the price prohibitive.
Precisely. If you could bring in more mid-sized jets, the charter price for those one-hour flights could drop significantly. That could unlock a whole new level of traffic, making it viable for more companies and individuals. It's about matching the aircraft to the mission.
Okay, that makes sense. What about the rules and regulations? Sometimes that can be a big hurdle for business aviation, especially in developing markets.
Historically, yeah, that was a challenge. Vietnam's aviation rules were really built around the big commercial airlines. That meant less flexibility, more costs for smaller business jet operations. But things have reportedly improved quite a bit in recent years. They've apparently put protocols in place for private flights at most airports now. That's making the process smoother for registering and operating business jets. And we're starting to see some local operators step in, offering charter, even things like air ambulance services using jets. So the regulatory environment seems to be adapting, becoming more accommodating.
So it sounds like it's still early days, maybe a bit like uncharted waters, but the potential for companies that get in early could be really significant.
Absolutely. You've got the strong economic drivers, the foreign investment, growing high-end tourism, and an improving regulatory picture. Companies that can figure out how to navigate this, understand the local needs, maybe bring in the right kind of aircraft like those mid-sized jets, they could be really well positioned to not just succeed, but actually help shape how this market develops.
Wow, what an incredible range of topics today. A real deep dive across the aviation landscape. We started with those big global trends in Asia-Pacific passengers and cargo still growing, but maybe moderating slightly. Then we drilled down into how that looks for one specific airline group, seeing that complex mix of strong demand, but also cost pressures and financial adjustments hitting the bottom line.
Yeah, and then we jump to the future with that amazing solar fuel development. The first time it's actually been used in airline operations, huge potential for emissions cuts, and those ambitious cost targets too. And finally, we landed on this surprising, almost hidden opportunity in Vietnam's business aviation sector, driven by that powerful economic growth, but currently held back by a lack of the right kind of supply.
It really shows how everything in aviation is connected, doesn't it? The global economy, individual airline strategies, the push for sustainable tech, and then spotting these emerging market niches. Which brings us to a final thought for you, our listener. As the industry juggles this need for growth with the absolute necessity of becoming more sustainable, what kind of new pressures or maybe even unexpected opportunities might that create for airports, for technology providers, even for global cooperation in the next few years?
That's a great question. The industry is definitely in constant flux, always adapting, always innovating. It's certainly never boring to watch.
Absolutely. And that's all the time we have for this deep dive. We really hope these insights help you feel even more well informed about this fascinating world of aviation. Thanks for joining us.